Welcome back to my video about the fundamentals of capital budgeting. This video is about forecasting earnings. So, when you're going to make an investment decision, meaning that you're going to allocate funds to an investment proposal, you need to be able to build your financial model to help you support your decision. Your model typically has three stages. The first stage is that you're going to list all your investments that you plan to undertake. So in other words, you're going to list all your capital ideas. The second stage is that you're going to decide which ones to accept and which ones to decline. This is what we call capital budgeting. And here, the net present value investment decision rule is going to help you make that decision. And in the third stage, we're going to take a look at how much each of these investment proposals contributes to the earnings. Or in other words, how much the investments add financial value measured in terms of cash flow. Now, let's look at an example that we're going to use throughout this video. And the example is about forecasting earnings. But remember that forecasting earnings is not the final objective. The final objective is to calculate the underlying cash flow. Now, let's have a look at the organization. The organization is called Space Agency, and it has just paid a 300,000 euros for a feasibility study to assess a new product which is called SpaceCraft. The project has a life of 4 years, which means that after 4 years the project is terminated. So it means that we need to estimate our earnings for 4 years. Now, the estimates are that the company is expecting to sell 100,000 units per year at a sale price per unit of 260 euro. Now, let's look at an example that we're going to use throughout this video to estimate earnings. And we need to know that we first need to forecast our earnings in order to calculate the underlying cash flow. And obviously, we need the underlying cash flow to make the investment decision using the NPV investment decision rule. Okay, the project. Space Agency is the company in our exercise, and they just paid 300,000 euros for a study to assess a new product. And this product is called SpaceCraft. The project has an estimated life of 4 years, which means that the project is terminated after 4 years. Okay? The project is expecting to sell 100,000 units per year at a unit price of 260 euros. So we just looked at the details of our sales side. Now let's have a look at our cost side, starting with an upfront R&D outlay of 15 million. Remember that the upfront R&D has no depreciation expense, okay? The upfront new equipment, however, 7.5 million, has a depreciation impact because the expected life is 5 years. And the new equipment is housed in an existing space lab. I'm going to provide a little bit more detail about the level of depreciation related to the new equipment. But for now, we just leave it at 7.5 million at an expected life of 5 years. The project is expecting to pay on an annual basis 3 million in selling and admin expense. Furthermore, the unit cost is going to be 110. And last, we have information on the size of net working capital based on sales and cost of goods sold for year 1 until 4. I have a separate slide on how to calculate all of this a little bit later, But for now, I would like to refer back to our video on financial statement analysis, where we have defined working capital as current assets less current liabilities. Let's have a look at the capital expenditures and depreciation related to the investment in new equipment. What we've seen in the previous slide is that Space Agency is investing $7.5 million in new equipment, which of course is considered a cash outflow because you need to pay another company to acquire the asset. What we need to see is that the $7.5 million is not directly listed as an expense in the profit and loss statement when calculating the earnings. Instead, Space Agency is only deducting a fraction of the cost of this item each year as a depreciation expense. So the depreciation expense is actually related to the asset's cost divided equally over its life, which means that we have an outlay of $7.5 million. The economic life is 5 years. So it means that in our profit and loss statement, we can actually include $1.5 million per year as a depreciation expense. The alternative of taking $7.5 million at once in the profit and loss statement is not feasible. So in other words, we need to take $1.5 million per year instead. In capital budgeting decisions, so whether one decides to invest money in a project or not, interest expense is typically not included in the underlying operating cash flow calculation. Why is this? Because the project and its cash flows should be evaluated on its own and not on how the project is financed. So as a result, the complete capital structure, components related to debt and equity, should have no impact on the size of the cash flows of the project and should be excluded from the calculation. Looking at the taxes that we need to pay, and including what we said on a previous slide, that the interest expense is not part of the operating cash flow calculation, when we talk about taxes, we can simply take the EBIT times the underlying tax rate. So in other words, the level of income tax in the operating cash flow calculation is the EBIT times the underlying tax rate. In sum, what we try to do is to forecast our earnings. And we need to forecast our earnings because we need to calculate the underlying cash flow needed to support our investment decision. Okay, so forecasting earnings can actually be broken down into three categories. The first category is looking at revenues, second costs, and third depreciation. So in other words, if we have the revenues and we're going to deduct the cost/expenses and we're going to deduct the depreciation, we actually have calculated ourselves the EBIT. The earnings before interest and taxes. And from the EBIT, as we've seen in a previous slide, we need to deduct the taxes. Now, EBIT less taxes is called NOPLAT, net operating profit less adjusted tax. And this is the first part that we need to calculate the operating cash flow. In this table, I have included the incremental earnings forecast of SpaceCraft. And remember, SpaceCraft is the project of Space Agency. In the first column, I broke down all the profit and loss statement items. Sales, cost of goods sold, selling and general expenses, etc. In this column, I have the year 0. In this one, the year 1, etc. until year 5. So we have year 0, 1, 2, 3, 4, and 5. Now, let's have a look at the sales. So in other words, SpaceCraft is expecting at the end of year 1 a revenue of 26 million. That is of course calculated as 100,000 units times a sale price of €260 per unit. and in year 2, 3, and 4 the same thing. Cost of goods sold is going to be 11 million per year, and that is 100,000 units times the cost price of 110 euro per unit. So then we have the gross profit, which is nothing more than sales less cost of goods sold. We have 15 million as gross profit. Then we're going to deduct our selling and general expense. That's 2.8 million per year. Then we have research and development expense, and remember that we need to pay 15 million as research and development expense. We can't depreciate that, so it means that we need to take this one entirely as an expense in year 0 at the start of the project for 15 million. Okay? Depreciation is actually related to the equipment that we can depreciate. And how much depreciation can we take into account? Well, if we go to the previous slides, we actually argue that the equipment can be depreciated for an amount of 1.5 million for 5 years. 1, 2, 3, 4, 5. Then we have the EBIT, which stands for earnings before interest and taxes. And then, as explained in the previous slide, we need to deduct the tax rate from the EBIT to get to no plat. Looking at the size of the tax that we need to pay, we need to see that in year 0, so T0, and also T5, we actually have a tax benefit. Okay? Let's take T0 as an example. Here we have a negative EBIT, which is tax deductible. So we have a tax benefit of 6 million, and the 6 million tax benefit will end up in a loss of 9 million. 15 million plus 6 is 9 million negative. In year 5, the same thing. So we have a negative EBIT of 1.5 million. This is tax deductible, so we are going to add up the tax benefit. So in year 5, we end up with a loss of 900,000. And obviously in year 1, 2, 3, and 4, we need to pay taxes, that's the amount between brackets, and we end up obviously with a no plat, which is lower than the EBIT because we need to pay this amount of taxes to the tax authority. In the process of forecasting our earnings, we need to take into account real-world complexities. Now, in our model, we actually simplified our inputs. For example, we have a fixed sales quantity, and we also have a constant selling price and cost per unit. But in the real world, the inputs can be a little bit more complicated. For example, sales quantity may change from year to year, or the average selling price will vary over time. And the same goes for average cost per unit. Also that may change over time. In our financial model, we have not included any opportunity cost. And the definition of opportunity cost is the value a resource could have provided in its best alternative use. In our project, we're actually looking at the opportunity cost related to the equipment. And we actually know that the equipment is housed in an existing lab. And the opportunity cost is nothing more than we are not able to use the space in an alternative way. In other words, we could have rented the space out at a price of 200,000 per year. And this amount needs to be included as opportunity cost in our financial model. Looking at our fixed overhead expenses, we should know that they are fixed and therefore should not be included in the calculation of the incremental earnings. Well, for example, if space agency has overhead costs that it need to pay, regardless of the underlying project, then these costs should not be included in the forecasted earnings related to the project. Remember that in our financial model, we did not include any fixed overhead expenses. Looking at sunk costs in our model, we can actually identify the money that we spent on a feasibility study of 300,000 euros. this expense is irrelevant for our financial model and should not be included. Why? Because the decision to continue or abandon a project should be based only on the incremental cost and benefit of the project going forward. So in other words, if Space Agency has spent some money on a feasibility study before the project, we consider that as an historical expense and should not be included in our forecasted earnings. We also need to include or look at indirect effects of our project that may affect the profits of other business activities of the firm. So in other words, our SpaceCraft project does not have any effect on the profits of other activities of Space Agency. We consider this cannibalization, and cannibalization is when the sales of a new project displaces sales of an existing project. For example, our SpaceCraft project displaces sales of an existing project of Space Agency. And this is also what we need to take into account as an expense in the forecasted earnings. Let's further look at how to include cannibalization into our financial model. How does that work? Okay, Space Agency is telling us that 25% of sales come from customers who would have purchased an existing ticket for 100 euros at a cost of 60 if SpaceCraft were not available. So in other words, we have Space Agency as the corporate, and they are operating SpaceCraft among many other projects. And they are now simply telling us that 25% of sales are not unique to SpaceCraft. So that means that as a consequence, you need to exclude these sales and related costs from your financial model when you're forecasting earnings for SpaceCraft. Another way of looking at cannibalization is that the reduction in sales of the existing tickets of Space Agency is nothing more than a consequence of the decision to develop SpaceCraft. So in other words, we have to include the reduction in sales into our financial model. How does this work for our financial model? What we know is that sales go down from 26 million to 23,500,000. The difference can be explained by 25% times 100,000 units times 100. Okay? Cost price goes down from 11 million to 9,500,000, which is 25% times 100,000 units times 60. In this slide, I made a new table concerning the incremental earnings, including opportunity cost and cannibalization. The only items that have changed are sales, cost of goods sold, and selling, general and admin expenses. Looking at sales, we originally had 26 million, but due to cannibalization, it has reduced to 23,500,000. The same goes for cost of goods sold. Originally we had 11 million, but since we now need to exclude sales, we also need to reduce the related costs to 9,500,000. The gross profit after cannibalization is now 14 million for years 1, 2, 3, and 4. Let's now go to selling, general and admin expenses. We can see that we now have an amount of 3 million per year. Okay? In the previous table, we had an amount of 2.8 million per year. So the difference is 200,000 euros. This can be entirely explained by the opportunity costs of not being able to rent out the existing lab that we discussed in the previous slide. So the general and admin expenses now account for 3 million and not for 2.8 million because we have included here our opportunity costs of 200,000 euros. We have now come to the end of the video. We have discussed how we can forecast earnings, but remember that in project valuation, We need to determine its cash flow in order to make the decision whether to invest money in a project. So in the next video, we are going to discuss how we can get from earnings to cash flow and from cash flow to net present value. Please open the next video that is called Determining Free Cash Flow and NPV. Thank you.